Two neighbors open their 2026 renewal notices on the same afternoon, same home value, same insurer, same quote of $3,057. That renewal number is 46% higher than what the exact same coverage cost homeowners just 5 years ago. Premiums alone jumped 12% last year, the sharpest single-year spike either neighbor has ever seen on a renewal notice. This marks the fifth straight year home insurance premiums have climbed nationwide, with no sign of relief coming. Most videos about rising premiums just repeat that fact and move on without ever running the real numbers on fighting back. One neighbor keeps everything exactly as it is and simply pays the higher bill without a second thought. The other neighbor makes one phone call, betting a smaller premium beats a bigger safety net when disaster strikes. Raising a deductible sounds like the obvious money move, but the actual math surprised even the analysts who ran it. So, which neighbor ends up protected when something finally goes wrong, and which one only looks like they won? Before picking a side, both neighbors need to start from the exact same financial position so nothing skews the comparison. Both own a home valued at $400,000, and both carry identical replacement coverage under the same policy type. Neither one is wealthy or careless, they are simply the median household trying to keep a fixed cost from creeping higher. Overall, inflation rose about 16% across that same stretch, a much smaller climb than what insurance premiums just posted. A deductible is the amount a homeowner pays out of pocket before the insurance company covers the rest of any claim. Right now, both neighbors carry the standard $500 deductible, the most common starting point insurers quote by default. Neither neighbor has filed a claim recently, so their pricing reflects the area they live in, not their personal history. One of them is about to change that single number, and it will either pay off or backfire badly. That change is simple. The second neighbor calls the insurer and asks to raise the deductible to $2,000. Insurers reward that decision by cutting the annual premium by about 16%, according to actuarial rate filing data. That savings works out to roughly $489 landing back in the second neighbor's pocket every year, without lifting a finger. The first neighbor changes nothing, keeps the lower deductible, and simply pays the full renewal bill again this year. Side by side, the first neighbor's total cost this year is $3,057, paid in full to the insurer. The second neighbor's total cost is roughly $2,568, plus a promise to cover more out of pocket later. On paper, the second neighbor already looks like the clear winner, pocketing extra cash the first neighbor never sees. This is exactly the version of the story most personal finance articles stop at once the simple premium math works out. But that surface math is missing something. Both neighbors will only discover the moment one of them files a claim. That missing piece shows up the moment either neighbor actually needs to use the coverage they have been paying for. Every insurer treats a paid claim as new data, feeding it straight back into how they price the homeowner's next renewal. Filing a single home insurance claim raises the following year's premium by as much as 28% on average. Insurers call this shared database C.L.U.E, and it can hold a homeowner's claims history for up to 7 years. Repeat claims get penalized hardest inside a tighter 5-year window, separate from how long the full record stays on file. File a second claim inside that shorter window, and the increase can jump toward 49% instead. Multiple claims in a short window can also trigger a non-renewal letter, forcing a homeowner to shop for coverage from scratch. So the neighbor who kept the low deductible is not automatically safer. Filing that same claim can cost far more later. The actual dollars involved are stark. The average homeowner's insurance claim now costs insurers $18,311 nationwide. That average has been climbing every year recently, up from $16,801 just one single year earlier. Wind and hail damage is the single most common cause, making up 40.7% of all homeowners' claims filed. A typical wind and hail claim runs about $13,511, usually from storm damage rather than total destruction. Water damage and freezing claims average $13,954, often triggered by nothing more dramatic than a single burst pipe. Liability claims covering injuries or damage to someone else average an even steeper $31,690 per case. Fire and lightning claims are by far the most expensive category insurers track, averaging $83,991 per single claim. Theft claims sit at the opposite end, averaging just $5,024 nationwide, often close to a raised deductible amount. None of this means insurance itself is a bad deal. Catastrophic losses like total fire damage still make coverage essential. Not every claim is that dramatic, though. Plenty of homeowners file for far smaller everyday damage instead, which means a homeowner can pay years of higher premiums just to recover a claim barely larger than a car repair. That gap between a small claim and a raised deductible is about to matter more than either neighbor expects. That gap starts compounding the moment the second neighbor actually banks the savings instead of spending it right away. Every year the premium renews, The second neighbor moves that $489 difference straight into a separate savings account. The gap between the two deductibles is $1,500, the exact extra amount owed out of pocket on a claim. Left untouched, it takes just over 3 years of banked savings to fully cover that extra deductible risk. A standard savings account nationally pays only about 0.63% interest, barely keeping pace with a rounding error. High-yield savings accounts, by contrast, are currently paying around 4% annual interest at several online banks. Track that fund forward across 5 years without a single withdrawal and watch what real compounding actually adds. The second neighbor's bank savings compound to about $2,650, all from money the first neighbor never touched. What would you rather have sitting in your own account right now, earning interest or sitting in an insurer's? Meanwhile, the first neighbor has paid the full premium every single year with nothing extra sitting anywhere to show for it. Statistically, 5.5% of insured homes file a claim in any given year, according to industry-wide claims data. Run that probability out year after year, and the odds either neighbor eventually files as a claim climb toward 1 in 4. Most people own a home for decades, which means those yearly odds eventually catch up with nearly everyone. The moment a real claim happens, both strategies stop being theoretical and start being real money out of pocket. If the claim is small, close to that average theft loss, the second neighbor's saved cash covers it without ever calling the insurer. That means no claim on record, no future rate hike, and a fund that quietly refills itself the following year. If the claim is large, closer to that $18,311 average, the math shifts hard in the opposite direction. Now, the second neighbor owes $2,000 out of pocket before any help arrives, 4 times what the first neighbor pays up front. Stretch the timeline to a full decade, and the first neighbor has paid roughly $30,570 in premiums with nothing banked. Over that same decade, the second neighbor has paid noticeably less in premiums and still holds a growing account on the side. None of these projections assume a market crash or a bank failure. They are simply ordinary savings account math. Even a single missed year of saving that difference erases much of the cushion built up before it. So, the real winner depends entirely on which kind of year and which kind of decade each neighbor happens to have. But which kind of year or decade a neighbor has is only half the equation. Discipline decides just as much as luck. The entire high-deductible strategy only works if the second neighbor actually keeps that $489 untouched every single year. The moment that saved cash gets spent on something else, the safety net quietly disappears without anyone noticing. Would that saved money actually survive a slow month at work, a broken furnace, or a tempting end-of-year sale? Good intentions about saving rarely survive contact with a tempting purchase or a surprise expense showing up first. A job loss or a medical bill can just as easily drain that fund the same month a storm damages the roof. That is the real risk premium math never captures. Life rarely sends its emergencies one at a time. Nationally, only 50% of adults say they could cover a $2,000 emergency expense using savings alone. That single statistic decides whether raising a deductible is a smart bet or a promise the household cannot actually keep. The first neighbor faces the opposite discomfort, a locked-in higher bill every year with no flexibility to change course quickly. But the first neighbor also never has to make a judgment call about what counts as a real emergency. For a first-time homeowner with barely any savings, that certainty can matter more than any percentage written on paper. There is also a practical order of operations here. Raising a deductible only helps once that matching cash actually exists first. Someone who raises their deductible without building the matching fund is not self-insuring. They are simply gambling with a lower premium. Admitting that truth about your own spending habits is the least comfortable part of this entire decision. Both neighbors think they know which kind of person they are, but only a real emergency will actually prove it. A real emergency is exactly where this comparison has to be judged, not just laid out ahead of time on paper. Give the first neighbor's choice real credit. That higher premium buys complete certainty the moment a crisis actually hits. In a wildfire-prone state like California, insurers already project premiums jumping 16% in a single year alone. California's average premium sat at $2,455 just last year, before this year's projected increase took hold. That number is projected to climb to $2,843 by the time the 2026 policy year arrives. For a homeowner in that kind of high-risk zone, a locked-in low deductible can be worth every extra dollar it costs. Ask that same homeowner after a wildfire evacuation whether the extra premium was worth it, and the answer changes fast. Hurricane-prone states like Florida and Texas raise the stakes even further with a completely different kind of deductible. Instead of a flat dollar amount, insurers there often charge a percentage of the home's insured value for wind damage. A typical wind deductible in those states runs about 2% of the home's insured value instead. For this same home, That percentage deductible alone would total roughly $8,000 out of pocket before any help arrives. Now, give the second neighbor's choice equal credit too, since a household with real savings sees this decision completely differently. It was simply their own money held hostage by an insurer charging record-high prices for coverage they may rarely use. With only a 5% chance of a claim striking in any single year, the odds already favor the disciplined saver. For that disciplined household, raising the deductible barely counts as a risk. It is simply moving idle money to a better place. For even more aggressive savings, some homeowners push that same deductible higher still, toward $5,000 instead. Every homeowner sits somewhere between these two neighbors, closer to one side depending on savings, location, and risk tolerance. So if there is less than a couple $1,000s in savings, or the home sits in a high-risk zone, the lower deductible wins. But if a reliable emergency fund already exists and claims stay rare, raising the deductible is the mathematically stronger bet. Neither answer is permanent. Either neighbor can always revisit that deductible the next time premiums move again. Back on that identical afternoon, both neighbors opened the exact same $3,057 renewal number and simply chose to answer it differently. The real irony is that a fixed premium never actually guaranteed either neighbor a fixed amount of risk. Which neighbor sounds more like you right now? The one who wants certainty, or the one chasing the better math? That same certainty versus math tension shows up in plenty of other money decisions most people never actually run the numbers on. This video is for financial education only, not personalized financial insurance or legal advice for your specific situation. Run your own numbers against your actual policy, or talk to a licensed agent before changing anything on your coverage.